Okay, hello guys. How are you all? Can you hear me well?
Yeah, Marwan, we can hear you perfectly.
Okay, thank you, Celine. Okay, hope guys you had a nice week, and I'm happy to be back here. So let's see what's waiting us. Okay, so I think you can see my screen now. Uh, okay. Okay, so today it's our third workshop in this series. Today we're gonna finally start talking about how to make money and investing in the cryptocurrencies. And first of all, we're gonna talk about passive investing. Okay, so we still have three workshops, and this one we're gonna talk about passive investing. We're gonna see what's waiting for us next. So let's see what we will learn in this workshop. So as I was saying, we are now in 203. So how to invest in cryptocurrencies, introduction to how to invest in cryptocurrencies, and specifically we're gonna talk about passive investments. Okay, later on we're gonna talk about active investments, and finally we're gonna see some trading strategies in order to trade the crypto because I think if you watched my other workshops, like the 100 levels workshops that I gave last year, you're gonna understand why we need strategies in everything we do in the financial market, whether it's trading or investing. We need strategies. Okay, and passive investments and active investments are on their own, they are strategies. Okay. So let's see what we're gonna let's talk what is a passive investment, and we're gonna also see what is an active investment in this workshop. But in the 204, we're gonna go deeply into how to active invest. So overview about on this workshop. First of all, we're gonna have to think as investors. Okay, we're gonna see the mindset of an investor, and we should be able to shift our mindset into an investor's mindset when we are investing cryptocurrencies specifically. Okay, we're gonna talk why cryptocurrency specifically. Then we're gonna have to see, or we're gonna take a look about risk management and position sizing, basically. And we're gonna see why this is important to know before investing. Then we're gonna talk about passive investing in a shallow manner. Okay, we're gonna talk about passive investing in the mindset of an investor, which we're gonna talk about now. And then we're gonna see some how the historical performance is. Then we're gonna compare what is a passive investing to an active investing, just to know the difference before we go deeper into how to passive invest. Okay, so let's see. So we've seen this slide a couple of times before. So why we invest in cryptos, and we said that basically people invest to generate money, and smart investors always invest in undervalued securities and securities that have a high potential in solving problems, and all these things. Okay, but specifically, an investor invests in things that they are not there yet. Okay, so we want to invest in things that are not 100% succeeding yet. Okay, because they will be undervalued. So if something is already there, it's already made, it's already big, there is no point of investing in it, and investing in it will give us a small return, not actually a big return. So the right question to ask as an investor is, does it work yet? Okay, does this project, whether it's a cryptocurrency, a normal company, anything, we have to ask if it works. Okay, the right answer that we should answer ourselves is no and not yet. Okay, so we need to see the not yet in our answer, because if the answer was yes, as I said, it's the thing is already there, investing in it doesn't make much sense. Okay, so we need something that is not 100% succeeding yet, and we want to see not simply a no, because a no means that it won't succeed at all, and we don't want that. We want something that will succeed in the future, so that it's considered undervalued now, we invest in it, and then when it reached its real value, we make money. And basically that's what we want. We need to see no, not yet. And this is the good answer. The good answer is not yes in this case. And another thing that you should think about as an investor is the project itself. And if you watched the INV 106, which was like a prerequisite to this workshop, you're gonna get why I'm talking about, like, as an investor, you shouldn't think like I'm investing to make money. You should think that I'm investing because I believe in that project and I believe in its effect on the world. Okay, and the money will come as a byproduct, of course. So, as we said, we're gonna have to answer as an investor. These are the main questions that we have to ask ourselves every time we think about investing in anything. Is it there yet? And we talk about the answer. It should be not yet. And is there a demand for this product or project? So this is a very important question to ask ourselves. So even if a project was successful, will people need it in their daily life in order uh, to facilitate some things in their life, or they simply don't need it? Even if a project is successful, but people don't need it, they won't buy it. Okay, so for example, Bitcoin is a successful project and people need it, and especially big companies, because making transactions using Bitcoin, we talked about it earlier, is that this will cost less as commissions of transactions, and it's faster. It's gonna take minutes or maybe some hours to transact a big amount of money, while using the normal banking system, it's gonna take forever. For example, another coin, it's called the Binance coin, BNB. So Binance, we know that Binance is an exchange. Okay, it's a cryptocurrency exchange, and they get money from commissions basically. So every time you buy or sell your coins on Binance, they take some percentage as commission. But they made a cryptocurrency for them. It's called Binance coin, BNB, and that coin is doing pretty well. Okay, so but what is the project behind it and why people are buying it? So when you buy Binance coin, for example, and use Binance, the transactions fees or the commissions that they take, you will get a discount on it. So that's why people buy a lot of Binance coin, because they get a discount on transaction fees. So there is a demand for this project. Okay, and that's why people are buying it. And you know, when you buy something, its price is gonna spike. Another question to ask is that will it work in the future? Okay, now let's think about Bitcoin and Ethereum and all of these Bitcoins. Are they 100% working now? They are not 100% working nowadays. Not like they didn't reach their ultimate goal yet. Okay, there are still some points that these communities of Bitcoin and Ethereum are still working on it to make it better and better. So even these huge coins that we know, they are still not 100% there yet. Okay, so they are still undervalued by a lot of investors. Okay, and we believe that they will work in the future. Again, if you watched INV 106, you're gonna know how to know if something will work in the future. Maybe look at its project, its team, its roadmap, if the team is following the roadmap, and all of this. We talked about it in the previous workshops of 106. So if it work, will that also lead to a price appreciation? Again, even if a project work, but there is no demand for it, no demand means the price will not appreciate. So we need a project that if it works, the more demand will be on it, and its price will appreciate. Okay, and also we should always pay attention that some projects makes no sense at all. Okay, and so if some project makes no sense at all, that doesn't mean that this is a bad project or it's a bad idea. For example, Airbnb. Okay, its idea was like now it's acceptable. It's an acceptable idea. We understand it. But at the first, imagine that you are first hearing about it. Like it's renting a room in a stranger's house and whatever. So it feels a little shady. And also Facebook. And when in the first days of Facebook, like me making an account and posting about my everyday life with my pictures, maybe my children are posting their pictures and their everyday life. That was a bit not accepted by all communities at first, but now they are accepted. So a lot of investors, they took the risk and invested in these companies, and are a lot of companies which also have weird ideas which are now really accepted. So you should always like think in the future, to the future, how will this work and if it will be accepted by the community, and not judge it based on the first reaction of people toward a certain idea. Now this is the dividend discount model. Okay, the dividend discount model, it's a method used to evaluate companies by looking at the returns in the coming years. Okay, and it's used widely by financial engineers and investors. Okay, it's a lot common. So what do we mean by evaluate companies? So if we know that if we want to see how much money we are willing to put in a company, okay, so we look at the return that this company will give us in the upcoming years. So for example, if this company will gonna give us a constant amount of $100 every year, okay, and if the interest is 2%, at the first year you will gonna pay $98, for example, for the first year, okay, because it's gonna give you a return percent of 2%. And if you take into consideration the following years, this amount will be higher, okay. And a good course actually which will teach you this is INV 301, Engineering Economics, which also teach you a lot about variation. So it's not always constant, it may variate. Okay, so yeah, a good course about this is INV 301, and this is a lot used by investors, as we said. So, and this is why some companies have high stock prices, although they are doing nothing. So some companies, like in year zero, okay, basically they are doing nothing, but you see that their stock prices are very high. That's because people are valuating it depending on the future or the future forecasted returns that investors see, and that's why it have a high stock price. Okay, and same thing for cryptocurrencies. We are buying them because we are looking for the amazing solutions that they will do in the future. Okay, so that was how to think as an investor and how to keep your mindset as an investor mindset. Now, another important side to look at is the risk management and position, and let's see why. So a risk basically is a potential of involving danger, harm, or loss. This is in general. In finance or in the financial market, trading, investing, whatever, is the chance that an outcome of an investment or investment's actual gains will differ from expected outcome or return. Okay, so the risk basically it includes the possibility of losing your investment or part of your investment. So that's basically what we call as a risk. Now, why do we take risks and invest in these markets? Because we believe that the reward outweighs the risk. So a lot of people, for example, do skydiving. It's very risky, but again, they believe that the reward that they will get as fun, as excitement, it overweights the risk. So that's why we take the risks in the financial market, as we believe that we're gonna get a lot of money. Okay, so and it's important before we start investing to understand the type of risks. So we have generally two types of risks. The systematic risk, which also called undiversifiable risk or market risk, and this risk it impacts the entire market. Okay, so everything in the market will move in the same way, maybe down or maybe up. Examples as market crash, a war. For example, when the Ukrainian-Russian war started, we saw that the stocks, all the stocks dropped, for example. Okay. And the news about oil production also it affects the entire market because like all market segments are linked to the oil production. Okay. On the other hand, we also have an unsystematic risk. We call it diversifiable risk or specific risk. It's only affecting one company or industry in one market segment. Okay, and it can be avoided by diversifying. So, for example, in the market segment of technology, for example, quitting of a CEO, for example, of Apple will not affect other stocks. It will only affect Apple. Okay, or fire in their main offices or whatever. So, what do we mean by diversifying? Diversifiable, undiversifiable, and avoided by diversifying. So, when you want to invest, let's say you have $10,000, you don't invest these $10,000 in one company or even in one market segment. You have to diversify it, which means that you put a little bit in this company, a little bit in that company, and so on. Okay, so that if this company, for example, crashed, okay, some event happened which made its prices go down, okay, you have other companies that you invested in so that you compensate for your loss over here. But if it was a systematic risk, all of the stocks will go down. So all your holdings on all diversified companies will go down as well. So systematic risks cannot be avoided by diversifying. That's why they are named undiversified. So therefore, we need in any financial market to do risk management, okay, in order to reduce our risks, see if we can take a risk, and even calculate the probability of a certain risk, okay. And risk management is always underestimated by people. And without it, basically, your chances in making money and gaining profits in the financial market is very low. It's almost zero. Okay, so a conclusion: good companies and traders think how to reduce risk and not how to increase profit. Okay, that's how important is money management, and that's why companies hire risk management and risk managers and not profit managers. Okay. So always you should always invest in only what you can lose or risk losing. Okay, so if your income, for example, is $1,000, don't invest it all. Okay, you should take into consideration that you have a rent to pay, food that you have to get during that month, and so on. So only invest what you can lose. So let's see an example where we can see how much risk management is important. So let's say we have two people, me and James. Okay, let's say that in our bank account now, both of us have $10,000. Okay, now both of us are planning to get married in 3 months, and the cost of the wedding is $5,000. Okay. So, but me and James, we are also investors, okay? And at that day, we decided to invest in Bitcoin, okay? So I invested $5,000 in Bitcoin. Let's say the price of Bitcoin over here is $10,000. Okay, so let's say that this chart is the price of Bitcoin. Okay, and now at time zero, it's 10K. So at 10K, I decided to buy half a Bitcoin. Okay, so now I have a half Bitcoin because half a Bitcoin will cost me $5,000 because I'm taking into account that after 3 months, I'm gonna pay $5,000 for my wedding. while James was more aggressive about his investment, and he bought one Bitcoin for $10,000, and he was thinking that we bought, me and James, we are good investors, okay? We are professional investors, and we know that in the future the price of Bitcoin will go up. So he decided to invest all of his Bitcoin, and then when at the 3 month, he'll gonna cash out and make a bigger wedding and make me jealous. Okay, so let's see what happens. So unfortunately, for example, after 3 months, so let's say this is 3 months, the price of Bitcoin dropped to the half. Okay, so now it's 5K. Now what happened is that I still have 5K for my wedding, so I did my wedding and everything is fine, and I still have half Bitcoin. Okay, while James now he had one Bitcoin, but it's worth now 5K, and he had to sell it. Okay, because his wedding is now, so he had to sell it. So he was stressing out. He sold it. He now have 5K, and then he basically made his wedding, and now he have $0. Okay. Now after other 3 months, for example, what happened is that the price of Bitcoin went to 30K. So what happened now is that James now he have $0 and 0 Bitcoins. Okay, because he already sold everything and made his wedding. And that day I had 0.5 Bitcoins. Now it's on $30,000. So now I have 15K. Okay. And basically I have 0.5 Bitcoin, which is worth 15K. Okay. So you see James and I prediction was true that it's gonna go up, but in the short term, okay, it went down a little bit and then it went up. Okay, so this is a good example on taking risks into account. Okay, so we have risk of the wedding after 3 months. James didn't take into account that, so what happened is that he lost all his money, while I was able to make my wedding in 5K, and I was able to keep my Bitcoin, and then it went up to make for me a lot of profit. Okay, so this is the difference when you make risk management. Okay, and that's why a lot of people, for example, come and tell me and ask me, or ask any person, like, or any professional investor, I mean, what coins are you holding now? And because they want to imitate me or imitate that investor. So, but they are not taking into account that they may have risks that I don't. So imagine, for example, I don't have a wedding, and I risked all the 10K in buying Bitcoin. So after 3 months, I won't be stressing out. But James would be stressing out and selling his Bitcoin. While I have no wedding, I have nothing. I bought my entire 10K, and then it went for 30K, and now I have 30K. Okay. But I have the wedding and I took into account. So you shouldn't always imitate professional people or any other person who is making investments, because his or her risk is different than yours. Okay. So any question about money management and risk management here? Let me see the chat if you have something. Okay, great. Okay, so let's continue. So we saw now that I made money more than James by investing less money. And a lot of people think that minimizing risk is actually making less money. But the fact is that if you minimize risk, it's not necessary that you will make less money. As we saw in the previous example, we actually made more money by investing less because we minimized our risk. And that's why, as I said earlier, companies tend to hire risk managers rather than profit managers. Okay, because of this point. So minimizing risk is never meaning making less profit. Okay, so James could have only made more money if the price skyrocketed directly, but if you are an investor and you're forecasting um, price movements on the long term, because as we know, investors wait a lot. So it's a long-term investment. So if you can forecast something in the long term, but you cannot be sure how it will move in the short term. So on the short term, it may go down, okay, but you know that at the end of the day, it's gonna reach a certain point, okay? But that doesn't mean that it's gonna be increasing directly from the point down to the point up. It may go down, okay? So James could have only made money if the price went up right away. Okay. So that's why you should only invest what you can lose. If there is something that you have a risk, that you have a payment, an important payment that you have to do, you shouldn't invest in that money. Okay. And a rule of thumb, if it keeps you awake at night, it means that you are exceeding your risk capacity. And this means that you are investing in money that you shouldn't be investing in. You should invest less. Okay, so now let's go into passive investment and let's see what it is. So a passive investor is basically a long-term investor. Okay, investment in general is long-term, but passive investor is more like long-term and patient, and we're gonna see how. There is no consistent or continuous effort in this type of investing, okay? And it's a less stressing style. So trading, for example, day trading, you should always, every day, be 6 hours in front of your computer, seeing charts and trading and reading news and so on. But an investor, you shouldn't do that. You only buy what you want to buy after, of course, making work in fundamental analysis, which is taught in INV 106. That will only be the work, like choosing what you want to choose to invest in, and then you just wait for a certain amount of time. We're gonna talk about that more. So to passive invest, you would basically coin selection will be the first step, which is basically how to choose your coin again in 106. Buy them and then leave until future date. Okay, as simple as that. This suits you if you have other things to do in your life, if you have a job that you cannot, that doesn't enable you to sit 24/7 in front of your computer and seeing charts and analyzing charts. So it needs a little of work, but the bulk of work will be in the first step. Then basically you are doing nothing. Okay. So historical performance doesn't give an indication on future performance. So a lot of people think that if something moved, it won't move again. For example, in 2017 to 2018, BNB, which is Binance Coin, went from 11 cents to $25, which is an extremely huge jump. Okay, and a lot of people thought that, okay, this is it. But that doesn't mean that this won't happen again. It actually happened again. And in November 2021, BNB reached $669, which is also a huge jump from 25 to 669. So it depends. It doesn't mean that if a certain security jumped, it won't jump again and do a lot of returns again. Okay, so let's actually go and see some historical performance of some coins. 1 second. Okay, so I think you can see my screen again. You probably know this, it's TradingView. So for example, let's see a coin called Wax Coin. Okay, you can read about Wax Coin and do your analysis as I taught you in 106 to see if this coin is a good coin to buy or it's a bad coin to buy. So this is a Wax Coin, and yeah, so imagine you were an investor, okay, back in 2021, which is not far away. It's only 1 year to the back, half a year actually. Okay, so and you bought it where you made your fundamental analysis like I taught you on 106, and you select it as a coin, and you bought it in that day. So let's see how much money you would have made comparing it to today. So today's price, it's at this level. Okay, so I think now you can see it well. So if we use the ruler over here to see how much money we would have gained if it reached this level, so it's basically 588%. So it's multiplying every dollar you put into Wax coin by 5. So if you invested in $1,000 in 1 year, now you have $5,000. Now we are calculating on this level. So imagine you sold anywhere here, for example, after it was dropping. It would be 1,550. So it's multiplying your income, your investment, sorry, by 15 times. So if you invested $1,000, now it's $15,000 by 301 days. Okay, as you can see. So in 300 days, you multiplied your money by 15 times, which is a huge. These are huge numbers. So I think there is a question in the chat where we can find the recording. If I missed the first part of the session, we're gonna send it by email. No worries. And yeah, it's gonna be uploaded on our YouTube, and in the PowerPoint at the end, you're gonna see the link for the YouTube channel. Okay, so let's another coin, which is BNB, for example, which we were talking about in a couple of minutes. So BNB is also a relatively new coin. Again, let's say we invested in that year, and when we say investment, we are waiting for at least 1 year. Okay, so that's what we call an investing. So we are waiting years. So let's say you bought it. I don't know. Let's say you bought it in June that year, June 2021. For now, you would have made 50%, for example. So if you invested $1,000, it's now 1,500. If you sold here, for example, it's multiplying it by 15. Okay. If you invested back again, so you are making here 1,800%. So it's multiplying your investment by 18. So as you see, if you were able to catch it in the place where it's not there yet, okay, you will be able to make huge profits. Whereas if you invest in it when it's already known, okay, for example, as here, you're gonna make some profit, but not as huge as when it was still not known a lot, okay? And so on. You can always make your research as I taught you again in 106, and find new coins, which are still small coins, that you make your research on them and decide if these coins will have a potential in growing and making such a huge movements. For example, let's see Bitcoin. So Bitcoin, for example, if you invested in 2020, in the end of 2020, let's say, till now, that's 336%. And guys, in cryptocurrency, you can see how huge are the investments. So investing in stocks, for example, the average is 8% per year. Now here, see, in year, you can make 300% and more. We saw that BNB, you could have made 1,800%. So things are huge in cryptocurrencies investments. Yeah, okay. And a good hint over here, when you look at something like this with huge movements, it's better to toggle the log scale. Okay, this will enable you to see the trends easier. Okay, so I don't know if you watched guys before. I have a workshop which is 103 about technical analysis. It teaches you how to analyze charts and draw basically these lines and these indicators that I put over here. So this is an indicator which is in blue. Yeah, so it teaches you how to put these things and how to use them. In cryptocurrencies, especially for investing cryptocurrencies, since since coins have a huge movements, like in thousands of dollars, and for example, like Bitcoin was $7,000 that in 2020, now it's 44, it reached 669,000. So these things are huge movements. So in the normal scale, okay, you're gonna see that it's not very clear for technical analysis. But in the log scale, it's more representative. These movements are more representative. So these, for example, these drops and increases are now visible, whereas in the normal scale, they are not as much visible. Yeah, especially if you are seeing this and you want to toggle it to fit your screen. Okay, so always use the log scale. Only in cryptocurrencies, of course. Okay, so let's go back to our PowerPoint and go into passive investment. Okay, you can see my PowerPoint, right? Okay, so now let's see what is passive investing, why it's called passive investment, and we have something which is all called active investment. Let's see the difference. Okay, active investing is basically the process is similar to the passive investment, but we have extra steps. Okay, so again, we have the coin selection, we have the purchase coins, but we have extra steps, which is rebalance when needed, change coins when needed, and change asset allocation when needed, and then sell at future date, just like the passive investment. So these steps over here, which we're gonna go deeper into in the next workshop, these are what differ active investing from passive investing. Okay, now this active investing needs more work than passive investment, and of course, when you put more effort into something, it's gonna give you higher returns. So it's known that active investing will give you higher returns and bigger returns than passive investment, because you are rebalancing every now and then and changing your asset allocation. We're gonna talk about asset allocation in this workshop, and we're gonna talk about rebalancing in the next workshop about active investment. So let's compare the both. Passive investment needs less time, less effort, and because it's less time, less effort, also less risk because you are changing less often, so it'll gonna give you less reward. While active investing, it takes more time, it takes more effort, it involves more risks, but it gives you more reward, of course, if done right. So when we say if done right, that we are talking about more risk, but we have a good risk management. Okay, of course. And which is better? So you shouldn't choose active investing just because it makes more money. You should choose passive investing or active investing depending on your lifestyle. So if you have the time and effort and energy needed to do active investing, of course you go into it because it gives you more reward. But if you are busy in your life, if you don't want to spend time on doing this, you can go into passive investing. Okay, but I always advise you in life to invest. Okay, because and to learn to invest. Why? Because you work now when you finish university, now for the rest of your life, like the 30 years, the 40 years in your life, you will be working to get an amount of money and to make a retiring plan for the future. I know this is like thinking a lot to the future, but it's life, it's reality. So in the next 30 years, 40 years, you're gonna be working every day in order to make money and build your family and build maybe your own dreams, your own company, whatever. Okay, why don't you spend like 1 year or 2 year learning something which is investing and the trading in order to multiply that amount of money that you got through 30 years of working? Why you don't learn something to multiply it by 2 or by 3? Okay, so that's why I always advise you to invest, whether it's passive investing, active investing, or even trading, which is more active than active investing, basically. So, as I was saying, you should go with the one that suits your lifestyle best, okay, and not the one that makes more money. Because if you try to make active investing while you don't have the time and the effort, you're gonna fail and you're gonna lose your money instead of gaining money. And it will be like if you passive invested, it would be more, it would make you money more than active investing in that case. So yeah, if it doesn't suit your style, you will fail and lose money, even if that style is known to have more rewards. Okay, now let's go into how to passive invest. Okay, in details. So we will learn how to passive invest through the following steps, which are, we're gonna look about what is an optimal or optimal asset allocation and building a portfolio, coin selection, position sizing, and we're gonna see an example. So first of all, we're gonna learn what are asset classes, okay? Because we are talking about asset allocation. To know what is asset allocation, we have to see what are asset classes and the risk and the reward levels. So if we draw a graph, on the y-axis we have the percentage of the return, the profit, and on the x-axis is the percentage of the risk. You're gonna get this one for the financial market. Okay, so in cash you have less return, of course, and less risk. It's basically cash maybe won't change. We are talking here if you are trading, for example, Forex, which is foreign exchange. For example, we do Forex in Lebanon a lot by trading Lebanese lira and dollars for purposes of making more money, not because we want to get dollars or liras only. So a lot of people, for example, also trade euros and dollars, okay, also to make money. So this is the least return and the least risk. And that's why you see that, I don't know if you guys are familiar with leverages, but if you watched my workshops before, for sure you know what is a leverage is. So if someone here trades Forex, they use high leverages, okay, because the return is very low and the risk is very low. So they use high leverages, which makes the return very high, but at the same time make the risk very high also. Okay. Then we have bonds in the terms of risk and security and profit, then property, then equity, which is stocks. Okay. And if you zoom in into each one of these, you're gonna have more of these curves. And at the high level, you have alternatives, which are cryptocurrencies, for example, venture capitals, small startups, like we call them pink sheet stocks. All of these they give you high returns, okay, the highest returns as we saw. And we compared equity to give you 8% in a year and cryptos to give you around 1,800%, which is a huge difference. But at the same time, it's a huge risk. Okay, now, as I said, if you zoom in into each point, you're gonna get another curve. Let's zoom in into the cryptocurrencies. So if we zoom in into the cryptocurrencies, we're gonna get another curve of the return and risk. We have the Bitcoin over here. So the Bitcoin is the most stable coin. Okay, although we can look at the chart and see the crazy movements it makes, but yet compared to others, it's the most stable. So it have the less risk, the less return, and it's logical why it have the less return from the things that we were saying earlier, because like it's the most coin which is already there. Okay, then the top 10 coins, what I mean in the top 10 coins, so if you went to coinmarketcap.com, we're gonna go now. The top 10 coins are these ones, so they are more risky and more return, but the most riskiest ones with the highest return is the top 100. Okay, and the top 100, for example, BNB coin was in the top 100 where when it was very cheap. Now it's in the top 10. Okay, now investing in it will give you less return and it also less risk. But investing in a coin which is not known, it's not very known, it will have like Wax coin, for example. Wax coin now, I think it's not from the top 10, it's still from the top 100, but it was even in the top 1000 when I saw it, for example. Okay. So let's go and see coin market cap, because it's an important website which I still didn't show you in this series of workshops. Okay, so let's share the screen. Okay, so this is coinmarketcap.com, as you see up there. We're just typing it, you're gonna go into this one. Okay, this have a lot of information. Basically, this is the list that I was talking about. So Bitcoin is the top, then these are the top 10. This is BNB, which we were talking about, Ethereum. And yeah, so these are the top 10. Now these are the top 100, for example. Now, it doesn't mean that if some coins are in the top 10, that doesn't mean that they have a good project. Okay, there was a coin which called BitConnect. Okay, let me write it in the chat. Do your research about BitConnect. It was the second. So BitConnect. Okay, it was number 2, and then it turned out to be a Ponzi scheme, and all people who invested in it, the price went to zero, and people lost all of their money in it, and it was just a scam, and it went to zero, and now it's خلاص, it's gone. So not if a coin is in the top 10 or in the top 100, that doesn't mean it have a good project. So you should always do your research, as I taught you in 106. For example, let's see if we can spot Wax coin anywhere here. Wax. Okay, let's search for it. Basically, you can search for it up and see its rank. So Wax coin. It's basically 116. Okay, so it's also not in the top 100. Okay, it's more. So yeah, so these coins, such as the top 100, if they were good projects, if you were able to find a good project in these top 100 and invest in them, they will give you a higher return than good projects of the top 10. Okay, so let's dig deeper and see what I mean. Actually, I wrote about this in the PowerPoint. Okay, so optimal asset allocation, it's the process of diversifying your portfolio across several asset classes in order to achieve the best asset mix that optimize your return for your given level of risk. So looking at this one, guys, as I told you, if you can buy, for example, if you have $10,000, you can put all of them into the top 100, but that would be a lot of risk. And it would give you a lot of return, of course, but that is a lot of risk. You may lose them all. So the best thing to do is to diversify and put in all of these a little bit in each one so that you balance your risk and your profits. So let's see how. So there is a conservative account or portfolio, which is 75% Bitcoin and the 25% are altcoins. So altcoins are any coins other than Bitcoin, whether it's Ethereum or other coins. This is very conservative. Okay, it's a lot on the risk, on the lower risk scale, but again, this will give you a lot of low profits. It won't give you a crazy profits. Moderate is the 50-50. Okay, aggressive portfolio is 25% Bitcoin and the 75% are altcoins. Okay. So this is the asset allocation. When we say asset allocation, this is what we mean. So when I tell you guys what is your asset allocation, or if somebody asked you what is your asset allocation, your answer should be not one of these. And it can be in the middle, of course, but your answer should be, for example, 30% Bitcoin, 20% Ethereum, 20% I don't know what, and so on. Okay, and an important remark is that splitting with at least 10 coins is highly recommended. So at least invest in 10 coins. So 75%, for example, here in the conservative, 75% in Bitcoin, and the other 25% are in other 9 coins at least. If you can find more, it's better. Okay. And the 25, again, 25 in Bitcoin alone, the 75%, for example, if you have $10,000, 2,500 in Bitcoin, the 7,500 are in other 9 coins at least. Okay. So the hardest part is made here in the coin selection. Okay. So selecting these 9 coins other than the Bitcoin is the challenge, okay? Because you have to find the coins which have a good project, a good team, which you have hope that it will reach one day a big amount like BNB, like Wax, and make a crazy amount of money. And to do that, again, you need 106, as we said. So you need first to choose your asset allocation. So decide which one you want, okay? And when you let's say I decided 25.75. Now I want to find the 9 coins which I'm gonna divide the 75% on. So decide on the number of coins you want to hold. Maybe you want 9, I want 15. Select the diversifying criteria, one of these, and then do your fundamental analysis to find these coins. So the position sizing, it's simple how we do position sizing. So decide on the total amount of money you want to invest in, split that amount of money on the asset allocation as you specified here, and then divide the amount by price of each coin. Let's see an example to understand it more. So let's say I have $10,000 to invest. The asset allocation I chose is 40% Bitcoin and 60,000 and 60% altcoins. So after fundamental analysis, okay, the one that we learned again in 106, I chose the following altcoins. Now for simplicity here, I only took 3 other than the Bitcoin. Let's say I wanted to put 20% Ethereum, 20% ADA, and 20% IOTA. Okay, it can be like here 30, here 15, and here 15 also. It depends on how you're trusting these coins. So what do I do is that I divide the total amount of money on this percentage. So I'm gonna put 40% as we said in Bitcoin, so it's 4K, 2K in Ethereum, ADA, and IOTA each. Okay. So for example, if I want to do for the ADA, so divide the amount of money by the price of each coin to determine the number of coins to buy. Okay. So let's say I wanted to put $2,000 in ADA. Okay, how much ADA coins I'm gonna have? If one ADA coin is $1, then we're gonna buy 2,000 ADA coins. Okay, and after that, okay, you will have to wait for a long time, for like 1 year, as we saw earlier on the charts. For 1 year at least, or 6 months, it depends. Maybe it makes, maybe the market make a huge movement and you're gonna sell after 2 months. Who knows? Okay. And since you are waiting a lot, you should store your coins in a cold wallet for maximum security. Okay, so there is cold wallets and there is online wallets. A cold wallet is more secure. So if you're passive investing, it's better to use a cold wallet because it's maximum security. Okay. I think I talked about wallets in the first workshop. And if you're active investing, which we're gonna see in the next workshop, we won't use a cold wallet because we will always be buying and selling these coins and changing. So we won't put them in a cold wallet, because if you put them in a cold wallet, in order to buy and sell these coins, okay, you have to transfer them to an online wallet again. So yeah, it will be a mess if it's an active investing and you're using cold wallets. So yeah, this is about this workshop. these are the workshops that we did earlier. This is the link. Let me send it in the chat box. This is the link for the YouTube channel if you want to watch the recording of the previous workshops. Okay, so any questions, guys? You're welcome anytime. I hope you enjoy it, and if you have any comments, suggestions, anything, uh, feedback on how to give things more better and clearer, of course, we are open for feedback. Thanks to you guys.